Hi everyone, this is Rohit from Lifestyle Mastery, and I'm excited to have Ali Jamal, who is the syndicate lead at First Check Ventures and has more than 10 years of experience in various product and growth roles at companies like Zynga, Agoda, and Rappi, and most recently at PayClip. Ali, welcome to the show.
Yeah, really great to be here. Thanks for having me.
Awesome. So I do know you for quite some time. Never had a chance to get on the podcast, but finally did it. I loved one of the newsletters that you shared, and a very interesting journey about your uh, parents who moved to Pakistan. Your and your grandfather, sorry, chose Pakistan. Your parents chose US, and now you moved to Latin America, and one of your ancestors have moved to Africa. A super interesting journey, if you can talk about your childhood and what got you interested in this crazy world of startups and VC.
Yeah. I grew up in northern Minnesota. My parents were both immigrants. My mom was from Pakistan. My dad was from Kenya. It was kind of this really interesting mix, kind of being somebody, with this sort of more international background in a place that was pretty homogenous in a lot of ways and kind of very Scandinavian. It was northern Minnesota. So a lot of people, parents had gone to the same high school, their grandparents had gone to the same high school, right? There was kind of this joke where like, you know, we were there for 30 years, and even 30 years, they're still kind of like the new guy on the block, right? Like it doesn't kind of matter how long you're there, like because people have just been there for generations. Um, but I like to kind of make the joke that I feel like my childhood was a lot of ways kind of like that TV show, The Wonder Years. And I don't know if everybody out there seen it, but just kind of this very idealistic sort of kind of mindset, right? Where it was just, I think, pretty safe and you go and you get in trouble with your friends, but like you're not really getting in any real trouble, right? Like you would go and you'd go into the woods and hang out and all this sort of stuff. But I think this kind of more classical small town life was kind of mixed with all these stories of kind of parents and grandparents and all the stuff they had done, going and exploring all these other places. And you're kind of in this place where um, you're able to kind of go and explore other things. And so I was able to explore, I think, more academically. Like I didn't have to go and try to fit into one box from a young age, right? Like there was also sort of the rise of the internet at this time. And so being able to go and just learn more and have access to more and more information. And then, I think my parents did a good job of trying to get us exposure to other cultures and other ideas. And so had, been able to travel and see some things, but still very much kind of thought of myself as an American and as, this is where I wanted to be. And then over time, I got more and more exposure to other things in other places and just felt like I could have a bigger impact in markets outside the US than I could have in the US.
Super interesting because another thing you mentioned was like you're a South Asian guy from Midwest and investing into Latin America, and you also talk about there are 700 million people in Latin America with the same GDP as China, but I understand that you work with Rappi and few other high growth startups, but why Latin America and why you investing so much there?
Yeah. So one is I just think there's this huge opportunity, but two is I also think it is sort of the culture, right? And one of the things that I've been really excited by Latin America is in a lot of ways it kind of reminds me of what the US was supposed to be when I was growing up, right? The US was supposed to be this place where welcomed immigrants, right? You had people of all different cultures coming together to kind of build and grow and do things. And I feel like over time, I've seen the U.S. become more divided, and you know, there's more the differences between people are getting emphasized more than the similarities. And, I think there's this division between coasts versus the central parts, or Republicans versus Democrats. It just felt very divisive. And it felt like that was becoming a bigger and bigger thing where, you know, in Latin America, I feel like there is this mix of cultures and of ethnicities and of backgrounds, and somehow has been able to mold these things into their culture and become part of their culture, right? And so when you go to places like Brazil or Peru or Colombia, there are people that are of the native descent, people that are of European descent, people that are African descent, you know, a lot of Asian descent people that have come together to create this unique culture. Um, and it's reflected in, just walking down the street and the kinds of people you see. It's reflected in, you know some of I think Sao Paulo has one of the largest Japan towns and Chinatowns in the world, right? It's reflected in the food. And so it just, I felt like it was this idea that you can be from anywhere, you can come here, we want you here, we want you to help us build in a way that I didn't feel the same acceptance in the US. And I didn't see it kind of getting better over the last 20, 30 years. I felt like it's becoming harder and harder. And I think that's also why we see more and more people, come to the US to study and then go back to their home countries. I wanted to be a part of something that is welcoming to people, welcoming to outsiders, and trying to get themselves better through immigration, through hard work. And I really felt that culture was pervasive in Latin America.
Got it, interesting. And you led growth at Rappi and Payclip. What was the experience, working as an operator in these high growth startups, especially in developing economies?
So I think it's a lot of, similar challenges to what you have in the US, but then you also have to add in the fact that it is a growing economy. And so that means that sometimes there isn't the same infrastructure that you would have, when you're in the US, right? So sometimes you just have to be a little bit more scrappy, be more willing to kind of hack things together. Um, there isn't as much information out there, right? So you might not have all the standards that you would have in the US. But what I found was, there were a ton of really smart people who were, trying to learn and trying to build and grow things. I think the problem has just become a lot bigger and a lot more massive, right? You're just dealing with more employees, you're dealing with more, customers. Everything just seems to be more, especially in these kind of growing environments. And um, there isn't as much of this kind of history of success or legacy there, right? And so you have a lot more people where this is their first exposure to startups. This is their first, the first big thing that's been happening. And so I feel like that has created this sort of um, more kind of do it yourself type of culture. And there's not as much of a community there as there is in San Francisco, right? In San Francisco, you walk 10 feet and you run into another startup and you run into other people that are kind of doing similar things. In a lot of places in Latin America, you're the one that's doing it. And so, um, you have to kind of build out even a lot of the other building blocks in order to plug into the finance system, in order to plug into the customer, whatever, having Spanish as your default language instead of English. Like some of these things just become more challenging, and having to kind of start from base zero. But I felt like that also becomes a sense of pride within the company, right? And the fact that you are kind of going through and building these things from scratch, um, that this is the thing that is building the startup ecosystem in Colombia, in Mexico, in Latin America. Um, it's really like a dedication that is hard to replicate.
Got it, interesting. And I got to know about the syndicate and fund when you syndicated Shop Circle, which is like one of the best bets I made. And the founders are based in London. I met with Kyan and Luca, and they raised I think more than $120 million from investors like QED. But how did you get to syndicate a company like Shop Circle? And did you get to meet with them? Or obviously, because this syndication happened during the time of COVID, if I'm not wrong.
Yeah. So, they actually had slid into my DMs, as they say, as
Nice.
the young people say, on LinkedIn. And, we sent some messages back and forth. And, what they were proposing seemed interesting. So we hopped on several Zoom calls. Really kind of, I had some familiarity with similar models and they were able to answer all the questions I had, and I thought, present themselves in a really strong way. And this is one of the companies where again we kind of came in as one of the little first checks, right? So for me, it really is about trying to find these sorts of uh, game changing companies as early as possible. And so um, they were, I think, the first company in Europe that we syndicated through first check. Um, and they've had this incredible journey from when we invested, now almost 3 years ago, to today. And you know, top U.S. investors, top international investors have come in. They've continued to execute really well. And I think it just kind of proves out the thesis a little bit more, right? Like, ideas basically, it is possible to go and find these people a bit earlier if you're willing to look for it. And when you make these bets earlier, you get better returns, but it also is doing more good for the ecosystem. And so that's really what I find the most exciting.
Got it. And from what I understand, you're running the syndicate along with your job. So how much time did you spend your time, running the syndicate along with the full-time job?
Yeah. So when I started, I was working full time at Clip, and
Yeah.
then kind of part time on the syndicate, and kind of slowly crept up more and more. And then eventually I decided to kind of leave my job to focus on the syndicate and investing full time. Um, so in the beginning, it very quickly starts creeping up from 20 hours a week to 30 hours a week to 40 hours a week. And then all of a sudden it's all you're kind of thinking about outside of that. So it wasn't just the hours you're working, but your like obsession, right? And then this is also kind of during the pandemic. And so there's very little else to kind of get obsessed by. And so, I was staying with my parents and I just kept on talking about deals all the time. My mom was just like, shut up. We don't care about startups. All you do is talk about startups. And it's true, right? Because I was just spending all my time either at work or talking to startups. And, um, you know, she probably said it a little bit nicer than that, but, it does kind of like when you find, your life's calling, you know, you do become a bit obsessed. You do become probably a bit boring. And I might still be a bit boring because I am kind of obsessed with this stuff. And this is all I'm thinking about. Like all those other sorts of passions and hobbies that I used to have kind of become, distant, like 10s and 12s and 15s, because 1 through 10 is kind of all startups.
Quite interesting. And for the syndicate, how did you instill a sense of urgency in LPs to move and come into that fund? Because sometimes it becomes difficult for them to push along and close the deal, especially in 2023.
Yeah. So I think for me, it was actually the opposite. I didn't want to create these false senses of urgency or you know pressure or pressure tactics. I wanted people to come in when they felt comfortable, and so I think that actually was part of my value prop is, hey, come join the syndicate. You can see the deals I'm doing. When you see one that speaks to you, you can invest, and you can invest as little as $1,000. Um, I don't need you to make this huge leap of faith and just start giving me money or have it trust me right off the bat. Come and check this out. Find the things that you get excited by. Find the things that you think are going to do well. And, you know, it, it's really easy to go and ask the GP, okay, what's your hit rate? What's your IRR? And the honest answer, right, is my IRR is going to be very different than your IRR as a LP. I don't expect you to invest in every single one of my deal. I don't expect you to invest the same amount as I do in every single one of my deals. And so you are naturally going to have different IRRs than what the GP has. Um, and so because of that, I think it's this really unique opportunity in a way for you to make the, you know, you to support the types of things that you believe in as well. And I think that's kind of the beauty of the syndicate is that you get to choose what you believe in. You get to back the kinds of founders that you want to back. I like backing early stage founders. That's why I call my fund First Check. There are a lot of other syndicates out there where they will do, you know, later stage deals. There are funds out there dedicated to specific things like climate or crypto or AI. I think that the biggest opportunity is when you invest in companies at the early stages and when you back founders at the early stages, right? So, what is the thing that you believe um, that you want to support? Who are the types of people that you want to support? What are the industries that you want to support? What do you think are going to be the things that are going to be most important over the next 10, 15, 20 years? And I think that's the really cool part about this, right? Is that yeah, it's hopefully a great way to make money, but it's also a great way to back the things that you want to see in the world and to shape the world into the world that you want to be a part of.
Yeah, no, absolutely. And you mentioned about investing in pre-seed and seed, and a lot of times you have multi-stage investors, funds who are investing into seed, and gives a signal a big brand like A16Z or Sequoia is investing. Is it a right signal for for a founder to look at a multi-stage fund offer at a seed stage? Or do you think, because a lot of investors, I'm talking about LPs who are investing into syndicates, look at such big names which are investing into these companies. What's your view on this? What advice would you give to LPs on this?
Yeah, so I think these big name funds have big names for a reason, right? That they're really great funds.
Right.
That doesn't necessarily mean that they are specializing in these stages, right? A lot of these funds are focusing on later stages and writing bigger checks. Um, and I often see it as the opposite, right? Like rather than like, oh, the syndicate is investing and then they're getting follow-ons from these big name funds. These people lead with the fact that there's these big name funds that are leading the round. And, you know, I think the question then that I have is, okay, if these big name funds are leading the round and they really believe in it, right? These are funds that have multi-billion dollar funds that they can go and do this stuff. Why did you, as a syndicate lead, get an allocation in this $5 million round, right? Like any of these funds can easily write the full 5 million. Why didn't they write the full 5 million? How are you the next best person to get an allocation? Like, how did they not send this to their LPs or to other funds that they work with, right? Like, what is the way that you got access to this that is really happening? And I think that is like the bigger question, right? So like if you're getting access because that guy was your college roommate or something, then totally makes sense that you should have access. It totally makes sense that they would save a spot for you. If somehow somebody's passing this deal to you and it's supposed to be the super hot deal and it's supposed to have all these great investors involved, it seems like something's fishy there. So personally, I tend not to take it as a signal and I try to look at each company individually. Even the best funds, right, are getting 9 out of 10 of these investments wrong. So, you know, I wouldn't necessarily say like, oh, just because this big name fund is investing, it definitely means this thing's a winner. Um, that being said, right, like they have picked a lot of winners in the past, but they've also struck out a lot of the past. So you don't go through and look at all the things they made bets on that didn't work out, right? Um, and so my perspective is you should be making investments in companies that you really believe in and that kind of support the ideals and the thesis that you have. The fact that some other name investor is coming in is a nice to have, but shouldn't it be something that you really base your sole decision on?
Got it. No, absolutely. I totally agree with this. And 2023 had been a difficult year for emerging managers. But Will we see a ton of venture funds getting shut down? Because a lot of VC firms have not raised the next round of funding for their funds, and we are yet to see announcement on that. But what is your view on this?
So, I think there's different things happening all the same time. So, um, a VC fund typically invests over a 3 to 5 year time horizon.
Right.
So, um, you know, they typically have thresholds of where they have how much they have to have deployed before they can go and start fundraising again. So, it really kind of depends on all these different factors of when they started their fund, when they actually started their investment period, how much have they deployed, what do they deploy in, how do those what do those look like, um, and I think in general, right, that there's a lot more money sitting on the sidelines now than there was 3 years ago or 4 years ago. A
Oh,
lot of people in general are seeing a lot of you know issues in the potential market. We're also in an election year in the US, an election year in several other countries. That also sometimes tends to worry capital allocators. We've seen, huge issues in the public markets as well, right? And a lot of companies not doing so well after IPO. Um, and so I think it has been, in general, a tougher year for all investors. Um, I actually think it's not like if you already have the ability to raise a fund one,
yeah.
usually you are able then to raise a fund two, right? And the window of how much, because you've only had 3 4 years since you raised your fund one, there's really not enough of a history there for them to judge your track record. So I think with most fund ones, they're really betting on you as a person and a fund manager, the access you can get. And so I think people are going to be making those same bets into your fund too, because there's not going to be enough there yet to really make that judgment. So I think the people that are really going to be struggling are those that are trying to go from fund two to fund three or fund three to fund four. When you start to need to have a track record, and if those were in companies that are now getting marked down, and they're having more companies that blow up, and then I think that can make it tougher when your track record is bad. And then on the other side, right? I think for emerging managers, um, it's tougher to make the bets into emerging managers and into first time managers, uh, usually because they don't have that track record. Um, and so, I think some funds are going to shut down. Some funds might choose not to raise a new fund. We're already seeing some of these announcements kind of happen. We also might see a general reshuffle, right? And if fund two didn't really make that much money, and fund one isn't looking that great, and they don't think there's a great chance of doing a fund three, they might different GPs might split up. They might go off and do their own things. They might rename the fund and change the thesis or whatever, right? To try to shift, to try to pivot, to try to use less of that track record and use more of their own. So I think it really depends fund to fund, and um, I think it's going to take a while for everything to shake out, and it's not just going to happen overnight. So I think it's going to continue to be tough to raise new funds and to raise fund threes and fours, for the next several years.
Okay, 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 got it. And will you see more or less of M&A in the next 12 to 24 months?
So, I think what's going to happen is we're going to see more and more companies that, raise big rounds of 2020 or 2021 that now need to go to market. And it's going to partially depend on how the investors are feeling and if they're willing to continue to make that bet. And if they've kind of run out of runway, they haven't been able to get to cash flow positive, and they're not able to get more cash from VC. I think the next obvious path is through acquisition. So I think that will lead to M&A, But oftentimes we think about M&A as being this you know positive outcome because everything's going up, and it might actually be more acqui-hires. It might be more bailing out companies that aren't doing so well. Maybe it will be acquiring the technology for better purposes, but I just think there's a lot of reasons why a company can get acquired, and they might not always be the positive ones that are going to see.
Got it. And what advice would you give to, managers and VC funds on when and how to take liquidity in the best positions, because it's always a difficult decision.
Yeah. Uh, so I think the biggest thing, right, is kind of understanding. One is kind of having your own thoughts on the company, how the company's doing, what you think is going to happen, but then also understanding your LPs, right? Because ultimately, in you as a GP are the shepherd for these other people's money, right? And so if they want more liquidity right now because they have whatever other things happening, um, you should be thinking about and exploring the options there. If they also still see a lot of potential in the company's portfolio and want to continue to support them, you should probably also continue to figure out ways to do that. And so um, there's not a one answer, right? It's really going to depend on all these different factors. Um, you know, there's this kind of constant struggle between letting your money ride or taking it out, and it's just I think anybody just says one thing versus the other is isn't really a value situation because there's a lot of nuance to it.
Got it. And I come from e-commerce, SaaS side of the business, and also because of my Indian background, I've seen a lot of IPOs which have happened in the last couple of years, which is a good signal for the Indian market ecosystem, but also for SaaS, e-commerce SaaS companies like Klaviyo had a good IPO. But do you think the IPO windows are going to crack open in the next 12, 24 months?
I think the situation there is a lot of these companies have raised big rounds at really high valuations again in 2020 and 2021.
Yeah.
And, I don't think the public markets are necessarily going to support those previous valuations. And so, people are going to have to make a bet about whether they think the market is going to get better over the next 12 to 24 months and whether it makes sense to start this IPO process now. Right. I think the reality is a lot of these companies, maybe half of these unicorns, right, are actually probably no longer unicorns and are probably, we're seeing it all the time now in the secondaries market where things are trading at, 40, 50, 60% of what their last round was. And so, you know, do the founders, do the investors in the company want to realize those losses and want to have the company go public, keep it as 50% off what they invested in the last round? Or would they rather continue to support the company and give them more cash at the old valuation or at some other valuation to be able to keep the value on their books at these different, at the higher valuation that their last round was. Um, and so I think sometimes it's just the politics of it, right? And again, if you're a lead investor and you're about to kick off the fundraising for your next round or for your next VC fund, um, you probably don't want to take the mark down. And so maybe you're willing to throw in a little bit more money at that old valuation, even if it's higher than what it should be, because you want to be able to show those markups and keep the markups high um, as you go out to raise your next fund. And so I think there's going to be some mix of, um, how the public markets are reacting, how the investors are feeling, and how your board is what the board is trying to do, and then what the startup itself thinks. I think all these factors are going to play a role. And so I think if the market rebounds, then I think a lot more companies are going to want to go public. But again, I think at least for the next you know 8 9 months until after the election, I think it's always a tricky situation.
Got it, interesting. And Peter Livingston from Unpopular Ventures, who's also an angel syndicate and also guest on the podcast, he mentioned something about AI, that AI models will end up like airlines. which means it's going to be very important, provide a lot of value to society, but terrible businesses themselves. So AI had a very interesting year, especially OpenAI had a revenues of close to around $1.4 billion, and looks like a lot of money is being put into AI. But what are your thoughts about AI business models, and do you agree with Peter's statement about AI business models, and what's to look out for them in 2024?
So I'm not an expert on AI, and I understand where Peter's coming from, where these same models are going to end up compete with each other, just drive the prices down.
Right.
Um, I think that can be said for a lot of things. And then, I think the same way it's kind of said in finance and fintechs, what you end up having is having more specialized fintechs where you're able to kind of create higher margins or create different opportunities because of the more specialization. So I think, even though these base AI models might end up competing with each other. There might be specialized models that end up having specialized trained data sets, which are going to be treated differently and probably going to be able to have higher margins and be able to grow and scale. Um, and then I think along with that, right, part of it is when you're thinking about AI, um, I think a lot more of the solutions with AI are going to be global solutions versus localized solutions. So I think something like a fintech, for example, you're going to have a different solutions in India versus the US just because you have different banking systems to plug into, different regulations of compliance. Um, and right now, there isn't that much regulation and compliance on AI. And so I think you're going to be able to have kind of global winners that kind of take over the whole market versus the localized winners. And so, um, I think that global opportunity kind of will depend on how much data is flowing into there and if they're able to create a monopoly or duopoly or how much it is versus I think when you kind of go back to Peter's analogy of the airlines, I think part of the reason why it becomes more of this commodity type thing is that there's just so many people that are able to offer similar services. But if you have exclusive data and can make a better system, right?
Right.
Um, I think there's an opportunity there. And I think we've seen this with other businesses in the past. And when you think about something like, you know, search engines, right? At one point, search engines was a commodity, and then Google was able to take enough data and improve the algorithms enough where they were able to extract a lot more value. And I feel like they're no longer seen as just a commodity with low margins. And search makes a ton of money um, for a lot of different products. And um, I think when you think about AI, I think it's going to be an overall shifting of the mindset and how that's going to change all these other components, right? I think it's going to change, search. I think it's going to change discovery. I think it might change a lot of different components. Um, and so, how does that play out? Um, and how is that AI actually being trained to understand the customer and the market and uh, the decision process? I think is really going to end up making the impact on the margins that are going to be able to exist.
Got interesting. And you've been an active investor. I was just wondering, what's your biggest investing win, and does it change the way you look at your approach to investing?
Biggest win so far is probably our first investment, which was in Yummy, the
Oh, nice.
Venezuelan super app. Um, and I think investing in Venezuela at that time was pretty controversial. Um, and it may be seen as a non-consensus investment, but I felt like it was like, even though at that time it was early, I felt like it just made so much sense to me that it felt like it had to become consensus. So, um, I think that's kind of become a larger part of my thesis is not making necessarily investments that are non-consensus, but making investments that are consensus but early, so that way we end up with the benefit of being early.
Got it. And what's been your biggest investment miss, like your anti-VC portfolio?
Um, Honestly, there were a couple of companies where um, we just couldn't move quickly enough. And so it wasn't that I necessarily didn't believe in the company, but that, you know, a round was happening and, it was hard to get the syndicate involved, or I forgot, and I didn't follow up on with an email or something, and then ended up, missing out. And so there are a couple of companies that we had the opportunity to invest in kind of very, very early that ended up becoming unicorns. Um, just because of speed of syndicating is just so much slower than the speed of having a direct fund to invest.
Got it. And in your view, what's the single biggest area of misalignment between a GP and an LP?
Um, I think in a lot of ways for GPs, it does well with funds, right? It really does start to become an AUM game
Right.
because you are making, the management fee on it. And so I, I would think that at some point management fees should probably be capped at lower rates. I
Right.
think the problem is that, as an emerging manager, the the management fee is that same percentage. And so, like, you have a $10 million fund and you have a $1 billion fund. I don't think you're doing 100 times more work with that $1 billion fund, but you're making 100 times more money in management fees, right? And there's just cost to set up the legal, cost to set up whatever. And so, I think the system doesn't really is sort of set up to benefit the incumbents, and I think that also ends up becoming part of the problem, right? Is that as you become an incumbent, you end up relying more and more on the manager fees. As your individual emerging manager, you end up becoming very reliant on the kind of carry because the management fees coming in initially aren't going to be that beneficial. And so I think that might also end up skewing how you make your investments or your decision process.
Got it. And Ali, I quickly want to do the top three. What's your favorite business book?
Um, so it might not be a traditional business book, but I read The Prince when I was in middle school, and I feel like that weird way is probably one of the better business books out there. Just trying to get yourself to think about the logic about how people make decisions and um, how to think about situations, how to you know go through the process of negotiating, and it's not a traditional business book, but just more traditional thought process. And I think it could be super valuable.
Got it. No, absolutely. Put that in the show notes. And if you could go back in time when you started working in startups and started investing into startups, what is the one thing you would have focused on or done anything differently?
Um, I think I wish I'd um, thought it out a little bit more in the beginning. And, I think whenever you start working or whenever you start investing, you kind of take it as this is the whole thing I'm going to do. And when you do that, instead of treating like you have different kind of goals and different outcomes versus thinking about this as this is day one on a 20, 30, 40 year journey. And I think if you start to think about this is going to be day one on a 30-year journey, you're not necessarily going for a home run on your first investment. You want to, the whole idea would be let's pick up as much knowledge as possible. Right. And
Right.
so, um, I think when I first started angel investing, I was writing checks that were bigger in size than they probably should have been because I was trying to, get some sort of oversized return or get some big home run. And, oh, I want to get a year's worth of salary out of this one bet. Um, I think it's better to try to make to try to learn as much as possible by making smaller investments and learn from each of these investments. Um, and I think the same thing would be true for the startups themselves, right? Like you kind of jump into working in a startup, you dedicate your whole life to this thing, and that's supposed to be what you're doing for the next 10 years. I think if you really think about it from more of a learning perspective, right, then you would give yourself different goals and you might set up that you want to transition in your role or transition into new opportunities on a more regular schedule. And so I think, um, I ended up kind of probably sticking around some companies longer than I should have, sticking around in roles longer than I should have, because you kind of get comfortable and rather than kind of forcing myself out of my comfort zone or forcing myself to learn more and thinking about this longer term journey. And, you kind of get stuck on, oh, I need to have a role or this title, or I need to have this or that. And really, you know, the, the more random things I've learned or the more random products I've done have actually probably been more beneficial than, just trying to move up the chain from senior to manager or whatever it might have been.
Got it. And what's your favorite online tool? For example, Gmail, Slack, Zoom.
So my favorite,
Online tool, for example, Gmail, Slack.
I use LinkedIn a lot. I feel like I'm always on LinkedIn. It's just like like I don't have inbox zero. I have inbox zero on LinkedIn, right? It's just very easy. I feel like I get my news from there. I see what people are up to. People actually update it, versus Facebook or whatever. And then I think it's hard to work in emerging markets without WhatsApp. Everybody just uses WhatsApp, and so it's probably that combination of LinkedIn and WhatsApp, being able to like quickly correspond with people back and forth, and being able to look up, what's happening, what's companies, who's doing what, and what's changing and shifting.
Yeah, no, absolutely. I think LinkedIn and WhatsApp are two of my favorite tools as well. And Ali, what's the best way people can reach out to you and know more about First Take Ventures?
Yeah, so even though LinkedIn and WhatsApp are both my favorite, it's probably just got to be LinkedIn. Reach out to me on WhatsApp and I don't know you, it's kind of weird. But totally happy to have you reach out on LinkedIn, and I try to respond to all the messages I get. Um, and so just make it a clear introduction and tell me what you're looking for, and I'll try to do my best to try to see if I can be helpful.
Sure, absolutely. We'll put that in the show notes. Ali, thank you so much for taking the time and speaking to us. I really enjoyed my conversation with you.
Yeah, likewise. Thank you so much for having me.